The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. I am Chris Chelius, part of the Option Ranger Development Group. For anyone who's missed our previous webinars, give us a call at 800-519-9085 and we can send you the videos you missed. You can also browse by topic on the Option Ranger website under Demo Videos. If you are a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so we can prepare a lesson plan based on your level, at your pace, and on your schedule. Now, an important disclosure, please be aware that trading futures and options involves substantial risk of losses and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read and understand all disclosures before investing. All of the examples discussed are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, type them in the chat box and we'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He is the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends in All Markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage Time Leverage Capital and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. And without further today, welcome to our Hot Market Fridays webinar. Mr. Mueller?
Thank you, Chris. Today's module, by request of a couple of folks in the program, is going to be on natural gas. Again, we're going to go over some examples. We were asked to go over some bullish examples on natural gas. Again, we are not recommending natural gas as a bullish market or as a bearish market. We are providing illustrations on how that opinion can be modeled out using different types of trades. So without any further delay, we are looking at the natural gas market. As you will recall, and we have these trades already saved to a tab, but there are demo videos on how you can input these yourself. The contracted market is natural gas. The helpful dialog box pops up with the contract specifications and the tick values. And as usual, there's an additional link here that will take you to complete contract specs and important items to monitor about natural gas. So in this particular case, let's go ahead. The first example we're going to look at is writing a put. This is a bullish trade, and as we know, selling a put, and we can go back to our dynamic strategy section. When somebody's selling a put, how is this a bullish trade? Well, it is a bullish trade. However, it is a bullish trade which has an undecided volatility outlook, actually an expectation of falling volatility. So this is not the most bullish trade there is. Selling a put is a bullish trade, nuanced with an expectation of diminishing volatility, as you can see in our strategy gallery. And when you select, as you know, when you go into the strategy gallery, for any reason you want to look at further particulars on that trade, then all you have to do is go ahead and click on that particular item, and you will be taken to the short put section. Just a moment, and there we are, in which you will be able to look at the trade itself. So again, we're going to go to selling a 430 put. This is a bullish trade with an expectation of diminishing volatility. In this scenario, the put that was sold, we're looking at May natural gas. For May natural gas in 2014, today's date is March 28th, 2014. The natural gas May contract at this time is around 4.491, so let's call it 4.5, and we are going to be looking at $4.50. Now we're going to be looking at the first trade that is bullish, which is selling, in this particular scenario, a put that is out of the money by 20 cents, a 430 put for a premium of 7. And again, how to input strike prices and premiums is listed in the dialog box and in the demo section. Now we get a quick spreadsheet which shows that this particular trade, based on the tick value, would collect a gross of $700 in premium. So this trade is going to be a credit minus this fee, and that varies by individual. We see a net credit of $645. And as we know, when we are collecting premium or selling an option, the net credit when the transaction is completed is also the maximum profit. So the $645 that is collected net is also the maximum that can be gained, $645. On the other hand, as is indicated in our strategy gallery and under the particulars, this is a margin trade. The 430 put is naked, and once the amount of premium that has been collected is overcome, there is a loss of $10 per tick move under 4.24, which is also listed here as a futures break-even. So in this particular scenario, intrinsically one is looking for the market to be above this level. So not only is it a bullish trade, but it's a bullish trade that accounts for the possibility of flat market or even slightly dropping market, as long as the volatility in the option diminishes as well with the volatility in the marketplace. So as we all know, and this is something that has to be monitored on a daily basis and is not done at this moment in this particular modeling, the premium that has to be a break-even level is 0.06, meaning that the writer of this option, if he can keep the whole premium, they make money. If they keep a portion of the premium, that's fine. However, if they have to buy back the position that they sold, and if to buy it back for more than 0.06 in premium, that means that that's where their losses begin, and it's at a $10 a tick level. And now we see them illustrated, because there's nothing better than a straightforward spreadsheet of intrinsic values. And again, as you can see here, we see our break-evens on the upside. The 645 initial credit is the most that can be kept on the trade. On the other hand, on a significant drop, this is, as we said, is a naked margin trade. So the market can really, if the market breaks to $4 and below, as you see the numbers begin to increase tick by tick on intrinsic value. So one should be very mindful that selling a put is a margin trade, and that the cushion of premium collected and distance from the market is maybe a benefit, but of course the counterpart is the risk of the naked option. So that's the first. That's one transaction that we looked at. For some people that like things to be very simple, we set up a natural gas tab here. Some folks just want to know what are the consequences of a pure natural gas play in the futures as opposed to stocks. Let's say they want or ETFs. So we have the values input here, and again we have the dialog boxes that take us to the contract specs and how to input an example. When the trades are input, even if when you input the trades for yourself, the dialog box will only open the appropriate boxes for entering values. So in this case, as you can see, when selecting a futures, the premium box is blacked out because there is no premium paid or collected. Again, we're looking at a market in which we are looking at a straight futures. We're factoring in transaction costs. There's no premium whatsoever, as we indicated. We have a review of the contract specs, and we see a very simple picture. The break-even point on this position is at 4.49. The profit is $10 per tick move above 4.49 and $10 per move tick below 4.49. So if one looks at a chart and they have objectives at 450 or 460 or 480 or 420 or 430, this is a way to quickly look at the dollar equivalencies of that contract. And let's have a quick look at the spreadsheet. It's very straightforward. Once costs are overcome, the position is in the clear for profits. And once obviously in addition to costs, if the market goes down rather than up, which is what a long instrument anticipates, then as you can see the losses increased. And we make sure that we list these because although some of these numbers, which are strictly mathematical outputs and perhaps very unlikely in the real world, should be daunting enough for people to decide whether or not it is a suitable idea to contemplate. So let's go ahead and continue with our next example. So we looked at buying a futures. Now let's have a look at a straight-out purchase of a call. And again, the difference, what is the difference in the purchaser of a call? Well, as we know, the purchaser of a call in this particular scenario, we go back to our gallery. It is indeed a bullish trade. We're looking at bullish trades on natural gas, but in this case, it's a bullish trade with an anticipation of rising volatility. So we did a scenario earlier in which the trade was bullish with an expectation of falling volatility, which was selling the put. Now we have an alternative to another bullish outlook in which one is bullish with an expectation of rising volatility. So that particular person might say, well, let me see how this can be accomplished by using a long call. And again, as we indicated before, in the case of selling a put previously, we have trade details on all those positions that take you to a graphic and a diagram with the particulars of the trade, the risk and reward, and then from there you will go into our demo and video library of instructional information and examples of how to input these particular transactions. So let's go ahead and now go to the master combination calculator and look at our next example, which is the buying of a natural gas call at $4.40. As we indicated, and as you will see on the spreadsheet, this trade relies on increasing volatility, and let's look at the numbers. The right to purchase, the right, but not the obligation to buy a contract at $4.40 is the purchase of this natural gas call. There's a premium debit of $2,100. That's what the buyer of this call pays for the right, but not the obligation to buy natural gas at $4.40 on this contract month. We've come up with the total outlay of money, including commissions and fees, using this default, and as you can see, the total debit on this trade, is $2,155. And now we're going to look at the profit and loss scenario. First and foremost, in the case of being long premium and not having any naked margin, as you can see in this particular scenario, the net debit paid is also the maximum loss that can be incurred on a trade. So the purchase of this long call is a limited risk trade. The risk is predetermined to a maximum of $2,155. However, as you can see also, the trade must overcome the premium and commissions paid, the total debit, in order to become profitable intrinsically. So first, as usual, we look at a futures break-even point or an instrument break-even point at 4.62. Although throughout a trade one monitors premium in order to know whether the trade is making or losing money at any given time or what the latest values may be, it is very important also to look at the strike prices and the break-even levels intrinsically, because sooner or later, if there's no offset and time erosion does its job in decaying the premium, then the only value would be intrinsic value. So there's always a balance between monitoring premium and volatility versus looking at the very objective number on expiration, which in this case for a futures break-even is 4.62, and the math here is simple. The 22.22 points in premium and fees paid has to be overcome, and then either on the premium or the market has to break out beyond 4.62 intrinsically by expiration. As we see, the maximum loss is limited. That's what a buyer of a call option achieves in paying the premium, and the maximum profit is unlimited. So since this person is expecting an explosive move to the upside with rising volatility, then they have a big potential if the premium and numbers break out. As you can see on a simple grid, the loss level, no matter how low the price of natural gas goes, is the maximum of the debit. Once the option goes somewhat in the money or intrinsic by expiration, those losses become smaller, and once the premium is overcome, the gains can be pretty substantial, again, because there is no cap. This is a long call that is uncapped, that has that predetermined risk. But again, we look at the spreadsheet to be mindful of the effects of erosion and time gain on options, which is the downside to purchasing premium. Finally, and let's go ahead, we looked at the purchase of a call, which is an anticipation of rising volatility, and then we move on to our last bullish example of the day. And of course, these tabs can be changed in a lot of ways, to change the strike prices, to adjust the premiums, to trade different months, to have different combinations. But in this particular case, we're still going to go ahead and use the May contract. And in this case, we've input a call spread. A call spread, as we know from our gallery, again, is a bullish trade. We're going up and down the bullish column with a few alternatives. And now this is for a scenario. A bull call spread is for a scenario of undecided volatility. So we've done an instrument example, we've done a rising volatility example, we've done a falling volatility example, and now we're going to do our final undecided volatility. Again, when you click on the bull call spread graphic, you will be taken to the particular trade details of call spreads, as well as some helpful videos on how to input the trades and post your trades for review. So let's go ahead, and now that we found a bullish trade with undecided volatility, the bull call spread, let's go ahead and have a look at it. Again, when call spread is selected, the particulars of how to input a call spread come out as a default. So somebody will not accidentally put in a sell instead of a buy on the top line with a purchase. Moreover, it's very important we also indicate that the transaction consists entirely of calls and have the forced inputs in the areas of strike price and premium, so that as well as cost, so that all of the necessary ingredients of the trade are achieved. And now again, we're looking at this transaction. In this particular scenario, a person thinks that the market's going up, but it's undecided volatility. They think it's going to go up, but not explosively, not slightly. It's kind of trend and trudge its way up. And for that expectation, they buy the long call, but they mitigate the costs and the premium by selling a short call farther out of the money. So there's a purchase for $2,100. That's the long call, which gives the buyer the right but not the obligation to buy the underlying instrument at $4.40. And then he proceeds to sell or write a call to somebody else to purchase that instrument at $4.80 in exchange for 5 premium points, or $500 in premium paid here. So the cost now is reduced by $500. The net premium paid is $1,600. You factor in costs, so now this trade would be $1,710. And again, because it is a net debit trade and there are no naked options, as you will see, the maximum risk or loss on a bull call spread with no additional naked options written is the amount of the net debit upon initiating the trade, which is the premium plus the fees. And we've already input in the break-even points both on the underlying instrument. So at expiration of this scenario, the futures break-even of 457 will suffice. If you will recall, in the case of a long call, a closer break-even was needed. So here we've got a break-even of 457, whereas when we look strictly at the purchase of a call, the futures break-even was 462. So we see here the $500, the difference of the $500 that were collected, as lowering the level at which intrinsically this trade would be breaking even. So for somebody who does not think the market will explode in a big way, in this particular case, they want to have that lower break even. They want to have the limited risk, and they're willing to forego, as you can see here, gains above 480 in exchange for the $500 for somebody else to have that opportunity. And now we look at the trade again. It's a net, the maximum loss and the net total debit on the trade are identical. The profit scenario in this case is limited because of the sale of the 480 call. So unlike the long call that we saw previously with an unlimited profit potential, in this case, in exchange for a lower break-even intrinsically and a lower outlay, the purchaser of this spread is also giving up some of the upside potential if the market exceeds the level at 480, where they offered to go ahead and sell the instrument that they have the right to purchase at 440. Now we look at the grid again. No matter how low the market goes, in case this bullish outlook is mistaken, there is a limited risk on a drop, which is one of the reasons people in many cases will opt to do long premium only trades. Then as you can see, the break-even comes in a little bit lower because of the premium collected, and once the market exceeds 480, everything above that 480 is a sweet spot with a maximum net gain of 2290. And as you can see, even on a smaller move to 465, 470, there are some fairly decent little gains, and this small area, if you will, is really the sweet spot for this trade, of course, along with a huge upside once you go beyond that. So, and again, as you can see beyond that, that's, once you get to this area, everything beyond there is capped. Finally, for those who are interested in doing different combinations and ratio spreads, the calculator easily lends itself to perhaps doing ratio trades. And again, this is just a quick example, and the type of ratio it is, and how many positions are bought versus how many are purchased, and the premium amounts will affect whether or not this trade would still be bullish. But let's go ahead and have a look at one example, and let me just go ahead and leave the values there. As you can see, the only thing we've done here is we've taken the call spread that was a 1-by-1 call spread and written a second option. All the other values are the same. So once we put something under a tab, it's very easy to work with these examples, and just on the fly, let's have a look at this. This is a ratio call spread. Okay, as you see, this is the smallest debit of all, because along with the one long call, that is a common theme. Now this person seems to feel more strongly that this market's not going to get anywhere beyond 480, and that there's a very reasonable cap above this market, so they can go ahead and sell the second option here. And the second option is a naked option in order to reduce their net outlay to 1100, collect more premium, and now the net outlay is 1265 after costs, and the profit loss scenario changes again with that one little change in input. The low break-even point now is at 4.53 intrinsically. The premium break-even is only 13 because there's less cost on this trade initially because there's more premium collected. The high break-even point, again, the low break-even point is for the high break-even point is 507. Let's see. Let's take this exactly to the spreadsheet and see how it looks. And this is where these spreadsheets begin to really help, because you can see first and foremost intrinsically if the range you have is a range that makes sense. So we already know that the maximum risk on a loss is predetermined. It can't be more than 1265. Even if a person sits on their hands till expiration and doesn't salvage premium or offset, that's the maximum loss. On the upside, as you can see, there's still that sweet zone of a spread, but it's bigger and higher at a lower cost. However, the fact that this little sweet spot area here is wider and is possible at a lower initial outlay has the converse, which is that the second option that was sold, the second 480, is naked. And if the outlook here that the market wouldn't go much beyond 480 is mistaken, and there is a margin of error, as you can see, beyond 480, and a person can decide whether or not this is sufficient to their anticipation or not. But regardless of that directional or volatility forecast, what we show here is the intrinsic value which of losses on the second naked option if the profits of the first spread and the premiums collected is overcome by an explosive upside move against the second and naked call option sold. So these would be 5 different scenarios of using the calculator to do a quick comparison of different strategies in the natural gas market taken directly from our strategy gallery and factoring in the directional outlook, which in this scenario was bullish, with a more complete or nuanced consideration of volatility. Are there any other questions from the group?
No, not at this time, Mr. Mueller.
Okay, I really enjoyed today's program. We don't know what the natural gas market's going to do, but it's very exciting to be able to look at it with all these different trading options. And if anybody would like us to model out any other ideas, please get them into us this coming week, or any particular markets, and we'll try to focus them on our weekly Friday markets webinar. To everybody, have a great day, success in your work, success in your personal life, and a wonderful weekend.
Thank you.